Common myths about crypto supply and demand. By this point, the mechanics of supply and demand in crypto should already feel more complex than the slogans that usually circulate online. This section exists to directly dismantle a few of the most persistent myths because these misunderstandings are where many people get misled. Myth 1: low supply automatically means higher price. Scarcity alone does nothing. What matters is how much of that supply is actually available to sell. A token with a low total supply but a steady stream of sellers can underperform an asset with a larger supply but tighter effective circulation. Price responds to selling pressure, not headline numbers. Myth 2: high demand guarantees price increases. Demand that isn't willing to pay higher prices doesn't move markets. Interest, attention, and even adoption can rise while price stagnates if buyers are price-sensitive or if new supply meets them at every level. Demand must be aggressive and immediate to matter. Myth 3: market cap shows how much money is invested. Market cap is a mathematical snapshot, not a cash ledger. It reflects the marginal price multiplied by total supply, not the amount of capital committed. Large changes in market cap can occur with relatively small trading volumes when liquidity is thin. Myth 4: if fundamentals are strong, price will follow. Fundamentals matter over long-time horizons, but price is set in the short term by liquidity, leverage, and positioning. Strong fundamentals do not prevent drawdowns, nor do weak fundamentals prevent temporary rallies. Myth 5: whales control everything. Large holders influence markets, but they still operate within liquidity constraints. Many sharp moves occur not because someone acted, but because others didn't. Liquidity was absent when it was needed. The unifying lesson across these myths is simple. Crypto prices are shaped more by structure than by stories. Once these myths are stripped away, supply and demand stop feeling mystical and start looking like a system governed by incentives, availability, and urgency rather than slogans or guarantees. Risk analysis, where supply and demand break down. Up to this point, we've treated supply and demand as if they operate cleanly. In reality, there are moments when normal supply and demand logic is overwhelmed by structural risks unique to crypto markets. This section exists to make those failure points explicit. The first breakdown comes from leverage. A large portion of crypto demand is not spot buying, it's borrowed exposure. When leverage is high, demand becomes fragile. Prices can rise quickly as leveraged positions stack on top of one another, but the same structure creates forced selling when price moves even slightly against those positions. Liquidations introduce non-optional supply into the market. These sellers are not responding to valuation or conviction, they are responding to margin rules. This is how liquidation cascades form. Supply suddenly floods the market, not because holders changed their minds, but because the system forced them out. The second breakdown comes from unlock and emission shocks. Vesting schedules, reward distributions, or protocol changes can cause effective supply to expand rapidly. Even if participants believe in the long-term value of the asset, the short-term increase in sellable tokens can overwhelm demand, especially if liquidity is thin. Markets often price this in early, leading to weakness before the supply officially becomes tradable. The third risk is sentiment-driven reflexivity. In crypto, price itself influences behavior. Rising prices attract demand. Falling prices suppress it. This feedback loop can push markets far away from equilibrium in both directions. When sentiment flips, demand doesn't gradually decline. It can disappear almost instantly, leaving price unsupported. Finally, there is liquidity withdrawal risk. Market makers and large participants do not provide liquidity unconditionally. During uncertainty, they step back. When that happens, even balanced supply and demand can produce extreme volatility simply because there's no depth to absorb trades. The core takeaway here is critical. Crypto markets can temporarily stop reflecting organic supply and demand and start reflecting structural stress instead. Understanding where and why this happens doesn't eliminate risk, but it explains why price sometimes behaves in ways that feel disconnected from logic, fundamentals, or fairness. Opportunity analysis, when supply and demand do matter. After walking through where supply and demand break down, it's important to be precise about when they do provide useful signal. This section is not about optimism or timing markets. It's about identifying conditions where supply and demand dynamics become more informative and less distorted by leverage, panic, or structural stress. Supply and demand matter most when effective supply is constrained and demand arrives without excessive leverage. Constrained effective supply doesn't mean low total supply. It means a meaningful portion of tokens are unavailable to sell because they're locked, staked, inactive, or held by participants with low urgency. In these environments, new demand doesn't need to be explosive to matter. It just needs to be persistent enough to absorb what little supply is offered near the current price. Equally important is the quality of demand. Demand driven primarily by spot buying, capital that is not immediately forced out by small price moves, tends to interact more cleanly with supply. When buyers are not overleveraged, price discovery slows down, volatility compresses, and moves become more incremental rather than chaotic. Liquidity also plays a central role here. When order books are reasonably deep near price, markets can process demand without extreme slippage. This creates a feedback loop where participants are more willing to place limit orders, further stabilizing price behavior. In these conditions, price becomes more responsive to gradual changes in participation rather than sudden gaps. Another situation where supply and demand matter more is during structural transitions. Examples include declining emissions, reduced unlock schedules, or sustained shifts in holding behavior. These changes don't guarantee outcomes, but they do alter the balance of what the market must absorb over time. The key point is this: supply and demand are most informative when markets are calm enough to let them operate. They don't eliminate risk, and they don't make price predictable. But in the absence of extreme leverage, forced selling, or liquidity withdrawal, they become a useful lens, not for forecasting, but for understanding why markets behave the way they do in certain phases. Comparison: crypto versus stocks versus commodities. To really understand crypto supply and demand, it helps to see it side by side with other markets people intuitively understand: stocks and commodities. Many misunderstandings come from applying the wrong mental model to crypto. Start with stocks. In equity markets, supply is relatively stable in the short term. Shares don't appear or disappear daily. Issuance events like secondary offerings are regulated, scheduled, and widely disclosed. Demand is dominated by institutions with long-time horizons, and liquidity is deep. Market makers and regulations smooth out price discovery. As a result, supply and demand interact gradually, and large price moves usually require large changes in information or expectations. Commodities operate differently, but they also have stabilizers. Supply responds to production capacity, extraction costs, and physical constraints. Demand comes from real-world usage, energy, manufacturing, consumption. These markets move with cycles, but they are anchored by physical realities. You can't instantly double oil supply, and you can't delete it with a software update. Crypto sits in between, but with fewer guardrails. Crypto supply is algorithmic and transparent, but not static in practice. Emissions, unlocks, burns, and incentives constantly reshape effective supply. Demand is not tied to consumption in the same way commodities are, nor is it anchored by regulated capital flows like equities. Liquidity is the biggest divergence. Crypto liquidity is fragmented across exchanges, often thin near price, and highly sensitive to sentiment and leverage. This makes price far more responsive to marginal changes in supply or demand than in traditional markets. Another difference is participant composition. Crypto markets are still heavily influenced by retail traders and short-term speculators, while stocks and commodities are dominated by institutions, hedgers, and long-term capital. That difference alone explains much of crypto's volatility. The takeaway is not that crypto is worse or better. It's that crypto is structurally different. Applying stock or commodity assumptions to crypto supply and demand leads to false expectations. Once those differences are understood, crypto price behavior stops feeling irrational and starts looking like a market behaving exactly as its structure would suggest. Long-term implications, no price predictions. When people talk about the long term in crypto, it's often framed as a price outcome. This section is intentionally different. The long-term implications worth paying attention to are structural, not numerical. Over time, crypto markets tend to evolve along a few consistent dimensions: liquidity, participant mix, and supply behavior. As markets mature, liquidity generally deepens. More participants place limit orders. More capital is willing to transact near the current price. Spreads tighten. This doesn't remove volatility, but it changes its character. Price movements become less erratic and more incremental because the market can absorb trades without immediately running out of depth. Supply dynamics also tend to evolve. Early-stage networks often rely heavily on emissions and incentives to bootstrap activity. As networks mature, those emissions frequently decline, vesting schedules complete, and the pace at which new supply enters the market slows. None of this guarantees favorable outcomes, but it does change what the market must continuously absorb. Another long-term shift is holder behavior. Over extended periods, supply often migrates from short-term participants to longer-term holders. This doesn't eliminate selling pressure, it redistributes it. Effective supply becomes less reactive to short-term price fluctuations, which can reduce reflexive swings driven purely by sentiment. Importantly, these changes are gradual and uneven. Crypto markets do not move cleanly from immature to mature. They cycle between phases. Liquidity can improve for years and then retreat during stress. Supply can tighten and then loosen again as incentives change. The key implication is this: long-term outcomes in crypto are shaped by how market structure evolves, not by any single narrative or metric. Understanding supply and demand as dynamic systems, rather than static facts, helps frame crypto as an evolving market, one where behavior, incentives, and structure matter more over time than short-term excitement or fear. Action framework: how to think about supply and demand. This section is not about what to buy, when to buy, or how to time markets. It's about building a clear mental framework so supply and demand stop feeling abstract and start becoming something you can reason about calmly. The first question to ask is always, what supply is actually available right now? Ignore total supply at first. Focus instead on effective supply near the current price. Are tokens heavily staked or locked? Are long-term holders inactive? Or is there a steady stream of new tokens entering the market through emissions or unlocks? Price responds to what can be sold, not what exists on paper. Next, ask, who is providing demand, and under what conditions? Is demand coming from spot buyers with longer time horizons or from short-term traders using leverage? Conditional demand behaves very differently from committed demand. If price moves slightly against it, will that demand persist or disappear? Then consider liquidity near price. How deep is the order book where price is trading right now? Are there real bids and offers close by or large gaps? Thin liquidity means small changes in supply or demand can cause outsized moves. Deep liquidity means the market can absorb activity without dramatic price changes. Another critical question is, what happens if conditions change suddenly? If price drops, does supply increase due to liquidations or unlocks? If price rises, does new supply emerge from holders willing to sell into strength? These reactions often matter more than the initial move itself. Finally, separate structure from narrative. Narratives explain why people care. Structure determines how price moves. When the two align, markets feel orderly. When they don't, volatility increases. This framework doesn't make markets predictable, but it does make them legible. And that's the difference between reacting emotionally and understanding what you're actually seeing unfold. Final reality check, summary. At this point, the goal isn't to remember every mechanic or diagram. It's to leave with a clearer mental model of why crypto prices behave the way they do, especially when that behavior feels confusing or disconnected from headlines. Crypto prices do not move because everyone suddenly agrees on value. They move because supply and demand interact at specific prices within specific liquidity conditions. What matters most in the short to medium term is not total supply, long-term belief, or broad interest, but effective supply, immediate demand, and how much liquidity exists at the margin. When those elements are stable, price behavior feels slower and more rational. When they aren't, even small imbalances can produce large, sudden moves. This is why crypto often feels chaotic. It's not because the market is random, it's because it operates with fewer buffers. Thin liquidity, fragmented venues, leverage, and conditional participation all compress decision-making into short windows of time. Price responds to urgency, not consensus. It's also why familiar narratives can fail. Fixed supply doesn't prevent drawdowns. Growing adoption doesn't guarantee upward price movement. Strong fundamentals don't override market structure in the short term. Once you see this clearly, many past market moments become easier to interpret, not in hindsight, but in logic. Sudden rallies, sharp drops, long consolidations, and violent reversals all start to follow the same structural patterns. The most important takeaway is this: crypto markets are not broken. They are behaving exactly as their structure allows. Understanding that doesn't remove risk, but it replaces confusion with clarity and replaces emotional reactions with a framework grounded in how price is actually formed. Conclusion. Here, if there's one thing to take away from this entire discussion, it's not a conclusion about where crypto is going. It's a shift in how to interpret what you're seeing. Most frustration with crypto markets comes from expecting them to behave like something they're not. When price moves quickly, stalls unexpectedly, or reverses without obvious news, it feels irrational. But once you understand supply, demand, and liquidity as systems, those moves stop feeling random. This info wasn't meant to simplify crypto into slogans. It was meant to give you a foundation, one you can reuse every time you look at a chart, hear a new narrative, or see a sudden price move that doesn't seem to make sense. Future topics, volatility cycles, market phases, risk management, leverage effects, even long-term adoption, only really click once this foundation is in place. Without it, everything else feels like noise. With it, patterns start to repeat in recognizable ways. You don't need to predict markets to understand them, and understanding them doesn't require constant action. The goal is simply this: when something moves, you can pause and ask why, using structure instead of emotion as your guide. If you continue exploring crypto through that lens, each new concept builds on the last, rather than contradicting it. That's how clarity compounds over time. Hello there. It's wonderful to connect with you today. I truly value these special moments we share together. Just taking a moment to appreciate this quiet time, it allows us to breathe and find some peace. Sometimes a little pause is all we need. Such simple acts can bring great clarity and deep calm. Thank you so much for joining me right here today. Your presence is greatly appreciated in this tranquil setting.